Hello everyone. Welcome to chapter 2, How to Value a Small Business. Okay, in this chapter, we are going to learn four main objectives. First, we are going to describe a small business model, and next we are going to look at how money flows through the business. Third, we are going to compare a small business to a large business, and fourth, we are going to do a really basic valuation technique for the small business. Okay, let's describe a small business. In order to do that, we will start them with a owner. Let's have a very wise and a smart business owner, Mr. John. In this example, we will have only one owner, John. John, that's it. As you move on to the advanced lessons, you will have hundreds of owners as you start dealing with stocks and really large corporations. Regardless of how many owners there are, you need to always remember that owners own the business. Now you might be laughing, but that simple concept is something that people really get confused. I have heard people say that they have bought shares and they think they are like one of the company's employees. I mean, some people get some twisted ideas whenever they think that. When they buy a share or a stock, they are anything but the owner. That's what they are. You are the owner when you buy shares of a business. So just keep that in mind. Okay, let's say that John had an idea for a small coffee shop business that he put in a small mall. Since John is accountable, he does not actually like to work at his business. He does not want anything to do with his business. He is going to hire one person to run the business, to sell coffee, to manage all the finances, to do everything. And all John going to get at the end of the year is check on how much his business made. So his employees are going to run the entire business. And I use that model in this scenario because whenever you get into buying stock, that's what the scenario is. As an owner, as a shareholder, you are not working for the company. Now you can do both. But when you're doing valuing techniques, you are trying to figure out the intrinsic value of a business. You always want to look at it from this point that you are not physically working in the business. You are an outside owner, and that everything that happens inside of that business is going to be paid to you, and you are not in there actually eating up the income that is producing. Okay, so that's the second part. So you first have to have a owner, and the second part, you have to have a business, and the third part is you have to have the customer. Those are the parts regardless of the size of the business. You can have this small little coffee shop that John owns, or you could be talking about big companies like Bank of America, General Motors, or Apple. Those three pieces are always in the model. So now that we have got the model established, the owner, the customer, and the business, let's look at how money flows through John's business. Okay, so this is just in 1 hour. And mind you, I have never owned a coffee shop before, so I really have no idea what it generates and how much it costs to run one bit. I'm just going to throw out these generic figures as we go through and see the flow of the money in 1 hour of John's coffee shop. So we start off at the beginning and we look at the customers. Okay, the customers go to the business and they spend $100 in 1 hour. So that would be the total revenue now. As I go through these figures, you want to absolutely remember the terminology because I am using the terminology that directly relates to stock investing. So whenever we go down that path a little bit further, all these terms are going to translate over. So the total revenue would be the money that all these people spent. So that $100 comes into the coffee shop. We are not even talking about any of the costs that John had or the employees that are working for John had while they are running the coffee shop. Now, as you take the $100, you walk across now, we step inside the business and we see where that $100 go. Okay. So $20 of that 100 in that our time frame went to his one employee. We are just using one employee to keep it simple. That one employee manages everything from brewing the coffee to keeping track of the books, and for everything, John is paying her $20 an hour. We had $20 go straight out of the 100 right off the top. Then we got all these costs of revenue of each one of these I am mentioning below. The next one is the material cost. So it costs money to make the coffee, to have the milk, coffee mugs, spoons, sugar, etc. So we are just going to say that that was $40, and then the last one that I threw in here was the cost for the rent for his shop that he's paying, say $10 for that 1 hour that he had to rent that space. So we add up all these numbers is called the cost of revenue. Okay, so we had the revenue which was $100, but the cost to get that revenue was $70 combined. When we took the 100 and we subtract the 70, we were left with $30. So that's the income before the taxes John's business made. $30 is the income before taxes. So let's just assume that we took $10 out of the taxes, and that leaves us with $20 of net income. Net income or the earnings, the term is vitally important. You want to write that down 10 times in a row and then write it down again 10 times in a row. You never want to forget that term, net income. And whenever you get into investing in shares and in the stocks, that net income, when you divide it down into one share, is called the earnings. So that's why I have both of these terms up there. Your net income and your earnings are pretty much exact the same thing. The only difference is when you talk earnings, you are talking for one share. So when a person says earnings, you need to listen because that is very, very important term. When the person says net income, you need to listen because that's pretty much the most important term you can understand because that's the end result. That's the money that has gone through the process and that is left over on the tray sitting right there for you as a owner. So, and that's the owner's money. When you own a share, when you own one share of a business, those earnings, that is your money. Never forget that, okay? So the $20 is what's left at the end. That's your net income, your earnings, and the owner now has the choice to do what they want with the $20. So John, in this situation, you can see I have two arrows. They're one pointing towards John and the one pointing towards his business. He can take that $20 he earned in that 1 hour and he can pay himself or he can put that money back into the business so that the business can make more than $100 in an hour so that he could invest in a coffee brewer or a new coffee making machine that's going to produce more income. He could do this too. He could take $10 for himself and just pay himself, and he could take $10 out of that earnings and put it back into the business. And that's what you will see a lot of business do. That they take a cut and they also put money back into the business. So the thing is that the earnings can go two directions, and that's something you absolutely have to understand when you start talking about stocks. The money that's going towards the owner is a dividend, and the money that's going back into the business can be retained in the equity. But we will get into that later. So the main thing I want you to really understand is the net income earnings. Don't forget the term earnings, a very important number, and it can be paid to the owner or back into the business. Okay, so we understand that model makes sense for pretty much anybody as they look at that because it's just really easy to understand. So when we look over here, I'm going to do a comparison between a small business and a large business. So as you look on the left, there is that small business that we just talked about and how we saw the money flow from the customer to the business and then to the owner. So when you talk about a large business, it's exact the same thing we had said. So let me put some pictures here to represent how that big business looks like. A lot of people have heard board of directors, but they have no idea what that really means or where that fits in the grand scheme of things. But now you do. As you look at the schematic here, you can see that the owners, the board of directors represents the shareholders. So let's say you went and bought 10 shares of Bank of America. Okay, your voice as a owner is represented by that board of directors. Those people standing there, uh, they are, huge shareholders. They might have 10 million shares of the company. And because they own so many shares, that is why they are a member of the board of directors. But when you own, let's say, you own 10 shares, you have a voice and you have a voting power with those shares. And that voting power is delegated to one of those board of directors. Okay, so those board of directors represent the shareholders and they are the ones that are actually, representing all the owners for that one specific business, Bank of America. So, as you step down to the business itself, this is where the CEO, which a lot of people know that term, the CFO and all this, those are all employees there. They can be owners at the same time, but their role as CEO is he is the head guy. He is the guy in charge of making sure that the product that Bank of America is producing is actually being made and that everyone is being paid on time and that all the products are being pushed out on time. So lot of times people get confused between board of directors and CEO. But the CEO is an employee and that the CEO works for the board of directors and all the shareholders. Okay, so let's value the business, and that's what we are really getting at here. And that's our objective to find out what is this business worth. We looked at this in previous scenario in chapter 1, where Mohnish says that the company is worth $50, but it's trading at $30. How does he figure that out? How does he possibly look at something and figures out what it's worth? So this is really a generic scenario of how you can possibly understand what a business is worth. So let's try to value John's little coffee shop business we know. And what I did here is I changed the cash flow from being 1 hour to 1 year. And all I did was just throw some zeros on all those numbers. And you can see instead of it being $100 coming in for the total revenue, now it's $100,000 coming in. So the revenue comes into the business at 100,000 and it costs him $70,000 in order to make the $100,000. That's your cost of revenue, which leaves you $30,000 before the income tax. You take 10,000 out for the taxes, which leaves John $20,000 in net income or the earning for a year. If John was going to try to sell the coffee shop, what is it worth? And you know what? I want you to pause the video and I want you to think about what would you be willing to buy this business for, knowing that you are absolutely going to make $20,000, and you are not going to have to work 1 hour in order to get it. Your employee is going to take care of everything. You are just going to make $20,000. It's a hypothetical question, but think about that. Let me pause. Okay, now that you have thought about the question and you pause the screen, his business really never changed. That business stayed exactly the same. It was making $20,000 through each of those three scenarios. But you can see that the expected return of anybody who would buy at those different price points, is going to get a different return. Okay, the business did not change. It is exactly the same. It's producing the same $20,000. But as you went through different purchase prices, as you pay more for that business, your return went down drastically. And the same exact thing happens when you are buying stocks. If you overpay for a stock, your percentage that you can expect to get each year goes down significantly. Wait, so the name of the game really comes down to what is the stock worth? And that's why Mohnish Pabra and Warren Buffett takes so much time and so much details as he's figuring out what these companies are worth, because he knows that based on what he pays for, his yield will go down 10%, 15%, 20%. So that is really the name of the game. And this is what I really wanted you to get out of this lesson. So, to summarize, we had four main objectives. The first was to describe a small business model, and the next was how money flows through a small business, a comparison of small business with a large business, and how do you value a small business. So that so that this concludes the chapter 2. And thank you, and see you soon in chapter 3.